Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we return to the metals markets. Growing interest from the public, growing interest from financial institutions have meant for an interesting and rocky ride for metals this year, including on the people side, which I'll cover. Where have metals prices been in general? What were the stories coming out of LME week? And in particular, what's happened with copper, aluminium and nickel? Where's the battery metals story at? And what's the outlook for 2025? Our guest is David Wilson, Head of Metals Strategy at BNP Paribas. As always, you can really support the show by leaving a positive review on the platform you're listening on, or following us on the platform you're listening on, or giving us a like on YouTube. It really does help promote the show and allow us to continue to get great guests. It would really help boost the reach of the podcast and obviously our goals as HC Group. And as always, I hope you enjoy the episode. David, welcome to the show.
Thank you very much.
So I'm looking forward to this. We are talking metals, a bit of a review of the year to date, what the vibes were from LME week, which happened a couple of weeks ago, and then tracking through some of the key metals and their pathway through 24 to date and what the outlook looks for in 2025. But can you just set the scene on kind of a meta level? You know, what has the year so far, broadly speaking, when it comes to metals, and then we can dig a little into that.
Yeah, sure. I mean, we've had a year of a number of different events happening. There was a huge excitement about metals in late sort of first quarter and into the second quarter. Huge upswell in investor interest, partly because of expectations of big China stimulus, partly because of expectations of US Federal Reserve rate cuts, and probably overhyped expectations of energy transition demand for metals. We saw this very significant rally, April, May in particular, and that faded quite rapidly as we progressed through into the middle of the year. And then I guess the sort of, let's say, the second phase of this year has been, again, China stimulus. That was a new package of stimulus measures announced on September the 24th, just before LME week. And that caused, again, a lot of excitement and everything rallied. And then as we've sort of progressed through October, there's been a sort of a switch in emphasis, more about markets now becoming somewhat concerned about potential policy implications globally of a Trump presidency in the US. So we've seen some prices rally twice. At the moment, things look a little bit subdued. It feels like we're in a waiting room, almost waiting pattern, let's say, waiting to see what the outcome of the November election is before I think we get another sense of the direction that we're going to go in.
Yeah, everyone's holding their breath. Let's go back to the early part of the year and that big run up in copper in particular, but all of the metals, which, as you say, we're starting to sort of see again or have done this last month. And this is a story which is somewhat new to metals, perhaps older to things like crude oil, where it seems that there is a sentiment is driving markets over the fundamentals. And that is because there's so much more financial flows in the sector, but also this sort of, very much, Wall Street Journal every weekend, you've got a piece on metals, its role in the energy transition. Can you just, I guess, help us understand part sort of A of that, which is, that new investor flows and that sort of sentiment piece, and then the corollary being how that, the perhaps the fundamentals were being overhyped.
Well, I mean, it was interesting because it began from really the 1st of April. And it looked as if there had been some high-level sort of fund decision to rotate into metals from the beginning of the second quarter. And I can't exactly tell you, if that's the exact situation, but that's what it looked like. That there seemed to be an aggressive pickup in desire for fund allocation to industrial metals from the 1st of April. And that's when we really started seeing the whole complex, but obviously particularly copper, beginning to accelerate. And I think the lead up to that was we had, there's been increasing talk about the demand implications of energy transition, the shift to electricity-centric forms of transport, renewable forms of energy generation. And it's obviously widely accepted that wind turbines, solar panels, solar fields are significantly more copper intensive than per megawatt hour compared to traditional forms of energy generation, coal, gas, nuclear. And I totally agree with that. This is going to happen. This is we are on the pathway to energy transition, and we are going to need more metals, more copper to meet that. The key really is to this is more about timing. I don't think you'd find anybody who would argue against that energy transition is going to drive demand. It's just a matter of when does that demand really begin to kick in and make a difference to metal market balances. And copper was probably more aggressively targeted by the fund community through April and into May. It always traditionally has been. It's the most macro traded of the industrial metals. And I'm sure if you've heard before, it's often referred to as Dr. Copper because it's seen as an economic bellwether, so as to speak. And as I said earlier on, we started to see this quite significant fund flow. And I think there were a couple of sparks. A number of our peers on the banking side were starting to put out really quite upside aggressive price forecasts for copper in particular. A number of the physical traders who were focused on copper were trying to sort of outbid those bank forecasts and go even higher. And I think that got markets excited. And then there was an underlying, again, this is very copper centric. There was an underlying supply narrative that there was going to be no supply growth, that mine supply was struggling to
this
grow.
Is Panama, right?
I mean, this was very much sparked by the government enforced closure of Cobre Panama. But obviously, we've seen for the last couple of years production struggles in Chile, in particular, and most notably the state-owned copper producer there, Codelco, really struggling to grow production. Actually, with Codelco facing contracting production. So there was a sort of, you could see that there was a positive story here. You had this demand story from energy transition and a narrative, and I'm going to emphasize the word narrative here, on a lack of copper supply growth. And it looked like a very appealing narrative. And I think that was probably the key to why we saw this rotation into metals from the beginning of the first quarter. The problem was the reality was the fundamental reality was a little bit different.
Mm. Which makes it challenging, right? Because you've got this sort of a narrative, a sentiment that gets amplified by those financial participants in the market. But as a physical trader, you probably, it's certainly an experienced one. Yes, it's, you want to participate in that price rally, but it's also, when do you jump off, knowing that actually the underlying fundamentals really don't support that current price level. And I think it's only those very sophisticated physical traders that have that derivative lens and view on where those markets are going that actually can have some window into how those algos are rotating, right? It's sort of the tyranny of the algorithms is kicking in.
Well, I mean, exactly. But it also, as you mentioned at the beginning, I've been doing this for sort of 20, 25 years. It helps to have been through a few cycles, economic cycles, and to know what data points to look at to try and get a clear picture of what is really happening. Because we have this situation, as you just alluded to, with regard to the algos, that you have this situation where the signals that the price is telling you are not necessarily the right signals in terms of reflecting the strength or lack of strength in the underlying market. And we were seeing a lot of signals in the market that was telling us that actually the fundamental market was going in exactly the opposite direction and weakening. I think the most telling one for me was that copper prices onshore in China were trading at bigger and bigger discounts to LME prices. Now, this would seem odd when you have China is the world's biggest producer of it's the world's biggest refined copper producer, but it's also the world's biggest copper consumer. It's the world's biggest producer of wind turbines, solar capacity, EVs, everything that's energy transition centric. And yet, we were seeing quite clear signs that Chinese demand was struggling. Chinese physical prices were trading at bigger and bigger discounts to London Metal Exchange prices, and physical premia to import metal into China were collapsing. And I think those were quite crucial in terms of indicating that everything wasn't quite as it seemed. And I think the market was also an element of misdirection in the copper market from a pricing perspective, looking at how COMEX prices were trading in reference to LME as well, because we had some odd situations with the sort of COMEX margin flaring out well above LME. I think that got a lot of funds excited, and the normal situation there would be if COMEX copper starts trading at it's a $300 to $400 premium to the LME. That would normally attract metal into the LME. Into COMEX, and close that arbitrage window. And that didn't happen. The arbitrage window kept on getting wider and wider and wider. And I think that perceived tightness in COMEX also kind of wrongly informed, particularly some US funds, that the overall copper market was tight, when the reality was, again, very different. Mm. But for me, the key points were looking really at China and the fact that Chinese onshore prices were not following the rally in the LME. And then we started to see Chinese copper smelters find it more profitable to export copper out of China and deliver to the LME. And that started happening quite quickly through April as the LME prices started rallying aggressively. And then into May, we saw physical premia for imported copper into China go negative for the first time in history. So that told you that physical traders actually didn't want to import copper at all. They weren't prepared to pay over and above a market price. Usually, a premium reflects the relative regional tightness or lack of tightness in a market. And when the premium went negative, it just told you that there was no one needed to import or wanted to import copper into China. And that, to me, was probably the most, or the clearest signal that the fundamental market was actually really struggling.
Yeah. But again, yes, you can't ignore, it's having both those lenses, and one of those lenses, i.e. sort of market sentiment and these different participants, has an outside effect. And while you might be right on the fundamentals, you've got to last the trade. There's an interesting subtext to this about sort of this growing interest in the broader metals trading space, which is, this year has also been a great rotation in, we've seen two trading houses in particular, build metals teams from scratch, to a really rapid extent. And obviously, if you work back probably when those conversations started happening, it was, in Q1 of this year. And again, it's part narrative. How do we get positioned for the energy transition whenever that, it's already happening, but whenever it starts to really kick off in the West, and then, but also kind of these outsized returns and, bondholders, stakeholders, all asking what's your metals exposure. But there's more of that in our Q3 market review. I can put a link in the show notes. Okay, so let's stay on copper. Yeah. You've given us the backstory as we sit today, and we should sort of date stamp this episode so whenever it goes out, people aren't, if things dramatically change, particularly in the wake of the election. So we're talking late October. Copper prices are really kind of back up where they were for the most part. What's driving that? And is this again just a replay of, China fiscal stimulus, et cetera, but we'll probably see the underlying fundamentals win over again in a few months' time?
Well, it's interesting actually, because I'd argue copper has actually underperformed the rest of the complex now. We're trading at just over 9,500, which is a decent amount below the highs we had back in May when it was over 11,000. Some of the other metals have rallied much better since that China stimulus announcement. I mean, aluminium in particular, again, for some slightly different reasons. Aluminium, I mean, copper did rally after the 24th, and we went above 10,000, but then it's given up those gains again, and it is at the moment struggling for any real direction. And I think if we dig into the underlying story now, is that I think, and this was a clear talking point. I mean, we can pick up on this a little bit later, but it was a clear talking point through LME week, which happened obviously immediately after the announcement of the fiscal stimulus package in China. That generally, I think the market is somewhat disbelieving that the China stimulus policy really does anything to drive real underlying demand in China, for whether it's buying cars, buying houses. Does it turn around the property market? The general perception is, or market perception is, that no, it really doesn't.
There's probably enough empty houses, basically.
I think, I mean, our economists did some wonderful work earlier on this year, highlighting that, I mean, in tier 1 and 2 cities, they estimated there was sort of 2 to 3 years worth of unsold property. And then in lower tier houses, cities, it was multiple more than that. So yes, I mean, there is a significant volume of unsold property that needs to be sold before the market is going to begin to look better. And also, I think, and we had a lot of conversations during LME week about this, and the general perception again seemed to be that, well, China's population is shrinking. It's also aging, and rural-urban migration has pretty much ground to a halt. So where is the natural source of demand for new property, particularly in a situate market environment where you have dramatically oversupplied market in terms of property available? So I think that very quickly the metals markets, and probably fortuitously because everybody was talking about it during LME week, metals markets came to the conclusion that the China stimulus, as it is, doesn't really have any meaningful impact. It has a meaningful impact in terms of driving financial assets, and obviously you've seen that. You saw a rapid rebound in the Shanghai Composite Index, for example. So we could see where money was flowing, but there's a high degree of skepticism whether it's actually driving a change in a spending behaviour by the Chinese population. And I had a lot of conversations about this, and the views I was getting really were that there would need to be more specifically demand-targeted policies to, I think, get metals markets more excited about a potential change in demand trajectory within China.
Which are very, very hard, yeah. What
Yes.
about that supply piece for copper? Is there continued concern about, production, just briefly?
No. I mean, this is the point, that mine supply, even without Cobre Panama, has actually been pretty good so far this year. It's grown around about 3%, which doesn't sound much, but for copper, that's actually quite a good level. We've started to see growth over the last couple of months in Chile. So there's been a number of projects that have been starting to ramp up in Chile. We continue to see very strong growth in the Democratic Republic of Congo, in Indonesia, in China itself. And it's interesting, a lot of analysts seem to overlook that China has quite sizable domestic mine supply. It doesn't get commented on that often. Peru is still growing as well. It's interesting, most of the major copper mining hubs are now showing growth, and there's expected to be more growth next year. So that's why I mentioned at the beginning this sort of narrative, and I'm holding up my hands and doing the inverted commas of saying narrative, because it's misleading. Mine supply has been good. And another factor that, again, most of my peers completely misanalyzed was that we're seeing more smelter capacity being added in the copper market this year and into next year than we've ever seen before over a sort of 12 to 24 month period. So suddenly you're seeing a lot more demand for copper concentrate from new smelter capacity, And that's given the perception that the mined copper market, the copper concentrate market is tight. There's an indicator that we as analysts typically look at, which is treatment charges that miners pay smelters to process copper concentrate. And those have collapsed this year, which tells you, yes, the concentrate market is tight. Normally, you'd assume that was because there was a lack of mine supply growth. And that's what most analysts have came to the conclusion of, which was completely wrong. This year, the difference has been the huge addition of smelter capacity. So suddenly you've had a massive demand increase for copper concentrate. And although mine supply is good, it hasn't been enough to feed that all of that smelter capacity. China's refined copper production has been absolutely surging this year. And they're obviously they have most of the world's smelter capacity. But we are seeing new smelter capacity being built in India, in Indonesia. A new one was commissioned just before LME week, and in DRC as well. And logically, if you think about it, suddenly if the supply side or the availability or production capacity for refined metal is accelerating, that's not the most positive.
No, it's going to flow
narrative
through,
for
right?
copper. Yes, and China's refined copper production has been growing by year to date. I think it's in the region of 7 to 8%, which is huge. China produces 55-60% of the world's refined copper, and so if they're growing by that much, it's a big volume.
And there's a broader question to sort of put a pin in, which is kind of like, is this 2014 all over again, right? Peak sort of people moves, into things like metals and lots of interest, but in reality, high prices have done what they do. They fixed high prices, and actually, we could be going into a longer bearish period as all of that spurred production comes into focus, and actually there's just not the demand story anywhere in the world that supports it.
Well, I mean, I think one of the key takeaway points was, and I did forget to mention this earlier, was that when prices were rallying through April and into May, Chinese copper product fabricators downed tools and just stopped. They just stopped buying copper, which that was why the Chinese copper market became quickly very oversupplied and Chinese smelters started exporting copper. So you could see that there is a demand reaction to that high copper price, which was copper fabricators just refused to pay it, stopped operating, drew down sort of inventories that they were sitting on. And it was one of the longest of destocks we've seen because it ran through April, May, June, and into July, and we only really started seeing the moves towards restocking in August and into through September, until we had that other, let's say, the China stimulus related rally where they stopped buying again. So, I mean, I'm not completely answering your question, but I'm hinting at it that we can see the end users are price sensitive and will refuse to pay higher prices, at least in the current environment. In terms of your question of is it 2000 and was it last year 23? I can't remember.
2014.
14, sorry.
Yeah.
And what, we're in for a long downtrend? No, I mean, if we focus on copper, the reason why mine supply is good now, and it's going to be better next year, is actually a lagged supply response to when copper prices first hit $10,000 a ton in, I think it was 2011, wasn't it? So that in itself is actually the long-term positive for copper, that it takes so long for the supply side to react to pricing signals. And we're seeing this wave of mine supply now that was actually incentivized by higher prices, a decade or more ago. And that I think is probably the narrative, the longer term narrative that is worth focusing on, that we're having a wave of mine supply now. It will probably peter out a little bit by the time we get to end of 2025 and into 2026. And then we're into this period that, again, if you go back to sort of 2012, 13, and when metals prices started deteriorating quite rapidly, mining companies started cutting their sort of investment capex budgets quite aggressively. And they continued doing that all the way until 2020, really. So you can put two and two together here and think, okay, we're having a wave of mine supply now. That begins to slow by 2026. Then what? Given that over much of the decade up till 2020, 2021, mining companies were aggressively cutting their capex, exploration, project development capex budgets. So there may well be a dearth of copper projects over towards the end of this decade and into the early 2030s, given it, that time lag it takes to develop projects. Obviously, the high prices this year, what have they done? I mean, they've incentivized more M&A activity or attempted M&A activity in the copper space. But I don't know if it's really moved the needle in terms of seeing mining companies step up in actually putting money towards developing new projects. I'm sure budgets have increased, but costs of projects have dramatically increased. If you, for example, wanted to develop a new project in, let's say, in Chile, in the Atacama Desert, where the bulk of the mines and the copper deposits are located, you now have to build desalination plant and water piping systems to bring water from the sea up to the desert region. And those alone are a couple of $1 billion before you've even started building the mine. I had a conversation actually with one of the Chilean miners during LME week, who suggested to me that the sort of incentive price level they would need to see on a sustained basis to incentivize more investment in Chile would be copper prices of around about $9,500 a ton. So where we are now, but we have to keep at these kind of levels to give companies the certainty that they can, whether it's permission from shareholders or their government owners or whoever, they can go ahead and start putting money into the ground in terms of developing projects.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
Okay, so changing tack, I guess you set the macro picture nicely for us, and also we've done a real good deep dive into copper. Can we just sort of spend 5 minutes on aluminium, aluminum, and nickel, and kind of, I guess, thread in those key trends you've been highlighting into that story, and then we'll sort of touch on battery metals briefly and gold. But yeah, can we just give 5 minutes on aluminium, aluminum, and nickel tracked that copper story?
For actually this year for aluminium, we were a little bit of an outlier as a house, that we've been more optimistic on aluminium than copper, and I think a lot of people thought we were a little bit strange taking that kind of view. And we've seen the aluminium market sort of properly tightening through this year, and we can see that through spreads. It is very different from copper. Copper time spreads on the LME have been falling into a deeper and deeper and deeper contango, which is another indicator that tells you there isn't a shortage. Well, aluminium spreads, although still in contango, that contango has been slowly narrowing. I mean, there were some games by one of the physical traders around certain dates this year, October, November, which tightened spreads a little bit. But if you put that to one side, the general trend in aluminium spreads has been tightening, and physical premia have been very, very strong, most notably so in Europe, where demand is actually quite poor. And the key reason here is that the supply side has been struggling for growth. I mean, it's a long-term story for the West. For say in North America, or the US in particular, smelter production has been on a general declining path since the early 2000s. Latin America, pretty much the same. And Europe, after power prices spiked to dramatically high levels in 2022, we had baseload power prices of 900 euros per megawatt hour in Germany and France in October 22. We've lost nearly a million and a half tons of capacity in Europe. So Western production has struggled, declined. And then 3 years ago, President Xi in China announced that China was going to, from his own volition, that China was going to introduce a 45 million ton aluminium production cap in China. So China would not produce any more than 45 million tons of aluminium a year going forward. And through this year, and particularly from about sort of May, June, China's smelters collectively have got to within a hair's breadth of that 45 million ton per year run rate, if you look at sort of monthly production. And the alumina market also has got very, very tight. Alumina prices have rallied by nearly 70% so far this year, spot alumina prices. We've seen alumina capacity closures. So alumina is the white powder material that the smelters refine or smelt into primary aluminium. We've seen capacity closures in Australia, Alcoa closing capacity, and Rio Tinto forced to close capacity because of a loss of gas supplies. We've seen alumina capacity being forced to close in China because of safety and environmental concerns. And the alumina market has got very, very, very tight. And this is something we were looking at months ago, but now suddenly seems to become more widely acknowledged by other market participants, and particularly funds. So when we've been talking generally about sort of fund activity, and a lot of it was focused on previously on copper, we're beginning to see a sort of fund interest more in aluminium at the moment, not because there's such a materially strong demand story. Demand is okay, particularly in China, less so in Europe, okay in the US, but because there's suddenly this very constrained supply outlook over the next couple of years. And the key has been China, and China deciding it's not going to produce any more aluminium. And China's imports of aluminium this year have jumped by about 100% year on year over the volumes last year. So we think China is going to import about 1 million tons more this year than last year. Last year it imported about 1.5 million tons. And we think next year there may well be another 1 million tons more than this year. And in an environment where there isn't a huge amount of supply growth at the moment, that's having a tightening impact on the aluminium market. And we can quite clearly see that, as I mentioned, in premia, in spreads. Aluminium historically hasn't had the same sort of investor interest, but it's beginning to get it now. And it's also the one metal where we've consistently seen quite aggressive consumer hedging, forward buying activity compared to any of the other metals. So every time we get any kind of dip, it has been bought into quite aggressively. So we talked about the rally, the China stimulus-related rally that sort of started just before LME week. Aluminium hit close to 2,700, but it only then pulled back subsequently to 2,500, 2,550, and was being very well bought. And then this sort of wider acknowledgement of the alumina market tightness seems to have piqued interest. And I mean, today we're trading at sort of mid 2,650 levels. Yeah. It's
so all you've got to do is catch the coattails of this rally as all that, the financial interest comes in,
yes,
and then short it right when it's peaked, because the story's gone way beyond the actual fundamentals. Easy.
Well, man, our end of year target for aluminium was 2,700, so we're kind of nearly there, really, within a whisker.
Let's turn to nickel.
I mean, nickel's an oddity compared to copper and aluminium, of the major base metals. It's one of the few where there's been massive supply growth. I mean, Indonesia this year will be producing near as you can get to about 2 million tons of nickel. And that's jumped from little over 100,000 tons back in sort of the early 2010s. The growth has been really, really quite phenomenal. I don't think I've ever seen any commodity where one country has gone from being a relatively small producer to being the dominant producer in such a short period of time. The market is looking dramatically oversupplied. And the key change that's happened over the last year or so is that all this production is in Indonesia is, the bulk of it is Chinese finance. And some of these Chinese producers last year started producing, let's say, LME deliverable grade nickel at plants in China. And this was a relatively new development. And so far, since July last year, the LME has listed, I think, 8 new producers as being producing LME deliverable material. So 7 Chinese and 1 Indonesian so far. And they've all started delivering metal, full plate cathode, interestingly enough, into the LME since September, October of last year. And it's consistent volumes every day. Interestingly, class 1 nickel and full plate cathode in particular is probably the one type of nickel that most nickel consumers don't actually really want. And that's probably, I think, the most interesting thing for me was there was this, if you go back a couple of years, some of the data providers like Bloomberg New Energy Finance were forecasting that EV demand for nickel was going to outpace stainless steel demand for nickel by sort of the late 2030s or early 2040s. And yet what we've seen over the last year and a half, particularly in China, is a significant pushback against the use of nickel cobalt-based batteries, where sort of a year and a half, 2 years ago, the split between nickel-based batteries and typically lithium-ion-based batteries, LFP, was around about a 50-50 split. In recent months, it's been more of a sort of 75, 25 split.
Beware battery chemistries. I mean, we covered LFP on this pod sort of a year and a half ago.
Well, it's a moving,
it's a moving feast.
And I mean, I'm no technology expert, but the pace of development of new battery chemistries, particularly right now in the LFP space, and you talk to CATL and some of the big battery producers, and they're saying that they can now get energy density in LFP batteries to be equivalent to NMC. There's obviously a big cost advantage using LFP, and car production is a relatively low margin business. So any margin improvement you can make, you will do. And we're beginning to now see Western auto producers, which had been the holdouts of still using NMC in their EV offerings, also switching to LFP. Yes, I mean, I think the demand expectations for nickel in the EV space were massively over bullish a couple of years ago. That spurred huge investment in Indonesian nickel supply. And now we've had this big switch and in the EV space. And there's still more new battery technologies coming. And look, I can't tell you whether solid state batteries will work or not, but a lot of the big battery producers are focusing on trying to productionize them. I mean, I mentioned in my LME week, we had an LME week event that I spoke at, and I actually posited the idea that maybe by 2030, we won't even be discussing nickel as an energy transition metal. A little controversial, but I can see that as a possibility.
That uncertainty, what's interesting about the energy transition is you're introducing a technology uncertainty that really isn't there with the internal combustion engine, right? You might have some changes at the margin about lead content or whatever it might be. But here you're navigating an energy transition narrative that is very much liked by Wall Street and funds and so forth. At the same time, though, the minutiae of the underlying chemistries can have a profound impact on whether your project gets off the ground or, et cetera, et cetera.
I mean, some people will tell you it's a very old technology because, Rolls-Royce's first car, well over 100 years ago, was actually electric using lead acid batteries. But I'd argue that the technology now and the battery technology now is still very young and immature and is developing rapidly. So I totally agree. There's a high degree of uncertainty.
So are consumer tastes, right? Like there's a certain amount of, everyone started off with it's just all about range, but as an established, in 20 years' time, it might all be about how many cycles you get in efficiency, like we think about our phones, right? How quickly your battery discharges, the health. Yeah, exactly. So there's lots of that stuff that has yet to be kind of worked out.
Well, I mean, my personal view is that if the battery producers crack productionizing solid state batteries, and then we have batteries that infinitely rechargeable, don't degrade over time, can be charged in 5 to 10 minutes, let's say, then that's the big game changer. Because I think right now, part of the problem facing sort of wider EV uptake is not the technology per se, but the fact that the cars themselves depreciate so rapidly, and part of that depreciation is to do with the pace of technological change. It's also got to do with the speed of degradation of the battery and so forth.
Mm. On those solid states, what as it pertains to a metal story, is there anything there, or these things are all sort of silicon based? And
I mean, there's still a lithium exposure, which is, I mean, I think if we had to pick, which of the three, let's say the three battery metals, and I'm going to say the three battery metals being nickel, cobalt, and lithium. I know there are others, but we don't really look at them. I would say the longer term winner is still going to be lithium. I mean, the issue with lithium is, I can see we're transitioning into more talking about the battery metals. The issue with lithium, in the same way that the issue with cobalt and the issue with nickel, is that they're all very, very oversupplied at the moment. But you can see with the sort of trajectory of technology travel at the moment that lithium is going to be the EV battery winning metal. Whether that means prices materially pick up longer term, it's probably a little bit more early to judge that at the moment, given that virtually every country in the world seems to have lithium deposits. There isn't a shortage of where the material is. Perhaps you'd argue that there's a shortage of the sort of processing capacity to change it into something useful.
Yeah. But even then, you've got that uncertainty around, is it DLE? We've covered a few times on the podcast, that could dramatically change kind of the current, what actually sort of lithium deposits are suitable to get into brines and so forth, right? I mean, you've got just these, and having definitely jumped on the lithium bandwagon, 3 years ago, feeling kind of disappointed.
We've been trying to call a bottom for a while.
Indexes
on going lower. So it's been, where we were trading, was it last week or the week before, down at sort of $9,500, and you think it wasn't too long ago when it was sort of, 40,000 or something. Yes, it's been a very difficult one to call in terms of that price, given the positive demand outlook at the moment. But I think you've highlighted the key point here, that it's that uncertainty about the technological outlook that is undermining it somewhat.
Yeah.
But I mean, of those three, I would still say that it's more likely to have an ongoing significant demand exposure to energy transition.
With copper, but kind of still being Dr.
Yes,
Copper,
no, I was thinking of the three battery metals.
Of those three, yeah.
Look, yes, copper will have a significant exposure. Aluminium, again, yes, very, very significant. I've highlighted I'm a little bit skeptical about nickel. Of the other industrial metals, I mean, zinc, very barely exposed to energy transition, galvanizing of the steel superstructure of offshore wind is about it. It's not really an energy transition metal, although I've seen some producers trying to push the idea that it is. I think that really encapsulates it. But I mean, yes, longer term, the demand winners for me would be copper and aluminium. And then sort of second degree, probably lithium. I mean, silver should be a winner as well. Silver is significantly used in solar capacity and related electronics. And we've seen very strong demand growth for silver in that end use. It's become the biggest industrial end use for silver. And that's something that sort of excites us quite a lot.
In the few minutes remaining, let's just turn to gold, because gold has had an interesting story this year, and there's obviously many different drivers in the gold market. And I guess my question is, I heard a long time ago that an ounce of gold historically has always held sort of its value to the price of a tailored suit. And so, which doesn't seem a bad rule of thumb if you look historically. Is gold's steady march up this year just a function of inflation? Tell us what's going on there.
It's very difficult to put your finger on one particular driver, because I think this year, more than any other year I can recall, that there have been so many drivers, and a lot of them have been sort of concurrent. I mean, if we go back to the beginning of the year, interestingly, gold was picking up from the early part of the year, not because of US rates expectations or inflation or any of those, let's say, traditional macro metrics, but it was being bought aggressively by Chinese retail investors. I mean, we saw record high Chinese gold imports in January, and the first quarter was a record high quarter. Normally, wouldn't look at the physical gold market as being a sort of potential price driver, but very much in the first quarter, Chinese retail activity was, and Chinese gold prices onshore were trading at huge premium to sort of NYMEX, which wasn't particularly normal. Why were the Chinese buying gold? Well, I mean, traditionally the Chinese mums and dads would put their savings into property or maybe equities. Property markets, you've had 2 years plus of downtrend in property prices, and Chinese equities were struggling. And there seemed to be a sort of a collective decision of, right, we're going to buy gold, which is exactly what they did. It wasn't the Chinese central bank. It wasn't jewelry. It was retail investment. And then we sort of transitioned into late Q1 and into Q2. So geopolitical issues began to come to the fore. There's been gold supportive. And then we also were obviously having, funds beginning to try and price in the timing of US rate cuts and a weaker dollar. So we saw a re-engagement with that kind of trade. And then as the years progressed, we started to hear some more talk from, let's say, equity funds beginning to look at wanting to have some kind of portfolio diversifier against rapidly rising, particularly US equities, if you look at the S&P, and some kind of hedge or portfolio diversifier against equity markets looking, I'm not going to say they're overvalued, but worry that they're becoming or heading in that direction. We also had talks with funds saying that they were looking at wanting gold exposure because of concern over growing US government debt levels and costs of funding. I mean, everywhere you look, there was some reason. Well, there were multitudinous different reasons that we were hearing for funds wanting to have gold exposure. Uncertainty about the US election was another. If you go back to the beginning of the year and you look at sort of voter preference statistics, and when the Trump campaign was really quite considerably ahead in opinion polls, gold prices were much lower. But as Kamala Harris took over the Democratic campaign, and we saw those sort of voter preference move closer to being neck and neck, gold prices began to rally. And then more latterly, as markets have begun sort of looking, I think, at more detail about potential Trump policies as he's moved back into the lead. And we've had a sort of, I guess you could say there's been a sort of an element of a Trump trade on gold. There's been growing concern about what some of his policy comments potentially mean. You look at the idea of dramatically cutting or even eradicating income tax on the one hand and replacing that lost federal revenue from imposing tariffs on all imports. Gold has started rallying, I think, on the back of concern about the potential implications of that type of policy, simply because you add the two together, and aggressive tax cuts would mean a significant jump in disposable income in the US, more money tracing a certain number of goods. They're likely to go higher prices. And basically, it's a return of inflation concerns, which is interesting. Yeah. I mean, I think the key thing for gold this year has been, if you said that if you want to try and encapsulate it, it's uncertainty. There's been uncertainty about everything this year, and that's probably been the word I would use for driving gold at the moment.
Yeah, uncertainty and a lot of reflecting. And the last time gold had similar rallies back in the global financial crisis, right? A lot of this was in the works, and a lot of discussion even prior to that about these concerns.
Well, I mean, that was interesting. Post-global financial crisis, gold rallied aggressively. And obviously markets were looking at the huge amount of money that governments collectively were pumping into the global system, assuming that this was going to drive inflation. Again, it was expectations of inflation driving gold, except over that period of time, inflation didn't materialize at all because all that money was just purely going into financial assets rather than in real markets. And I would say the key thing about the way gold behaves is it's always about anticipating a certain outcome. Because when we're in a high inflation environment, gold typically underperforms, because then once inflation is here, we're also into a rate hiking environment, and gold will tend to fall in a rate hiking environment. And I mean, again, I think the latter moves above 2,700. An element of that is concerns about a Trump presidency, let's call it a red wave, so an unhindered Republican administration from after November or whenever they start. And that's, I think, been the sort of most recent driver of gold. Quite clearly, if inflation does return, then gold's upward run would be stalled somewhat if the Fed had to react by stopping cutting or even reimposing rate increases.
Yeah.
But we'll have to see.
Have to see. I'm not a believer. Doesn't produce dividends. So anyway, well, David, it's been really, really fantastic having you on. I look forward to having you on hopefully a similar time next year when we can unpick the narratives. And I think you've given a really clear exposition of the challenges that the metals trading world faces, managing these narratives against the fundamentals. And obviously, though, the opportunity as well as metals do become more central to the energy transition or to the energy markets, that in the enormous representation that means for our global economies. And, it's great to have sort of help unpack and unpick that story of what's happened this year and a bit of a look forward to next year.
Absolute pleasure.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.